Over the past few months, there has been a flurry of activity within the mutual fund industry. Every fund house worth its name has been launching a fund with the word manufacturing in it. Why is there a sudden interest in manufacturing? Why are all the funds rushing to launch a manufacturing fund? Is it a fad, that is old wine in new bottle, or is this the next fabulous opportunity that we all need to take a look at? That's what we're going to check out in this video. As you're aware, India has had a rich tradition in manufacturing. Up to 3 decades ago, India had a vibrant manufacturing. In terms of manufacturing's contribution to GDP, it was a very, very healthy number, almost at about 30%. But over the past 3 decades, the services, especially led by IT, has taken the pole position, and therefore the share of manufacturing has steadily come down. Now, is that likely to change in the near term? Absolutely. That's what all the experts seem to believe, that over the next decade and a half, we should see the share of Indian manufacturing go up tremendously. What is the reasons for that? First, last week's economic survey that was released said that India needs to generate 80 million jobs every year to keep the aspiration of young India alive and kicking, which means that's a massive number of jobs that needs to get created just to make sure that every passing graduate gets onto a job after he completes his graduation. To do that, the current system of companies and service industry or agriculture is just not good enough. We need the bulk of these jobs to get created in the manufacturing sector, and therefore government is keen that manufacturing is really given a huge fill-up going forward. Next, over the past 3 decades, while India slowed down its manufacturing, so to say, China really went the other way and became the manufacturing hub of the world. Every notable brand that you can think of had a manufacturing base, at least one base in China, if not more. So China ended up being the manufacturing hub of the world because they provided great quality at very, very low prices. But COVID really hit home the risk of a single dependency. And because China was at the epicenter of the COVID problem, the supply chains of global manufacturing companies went into a tailspin. And we all know that story. Ever since that, most large global enterprises are looking for what is called a China plus one strategy, which means apart from China being a manufacturing hub for their products, they are looking at least 1, if not 2 places. And that's where India becomes interesting, because apart from China, India is one of the largest markets for consumption of products. So ideally, some of these global biggies want to have a base in India as well. Therefore, we believe India is on a cusp of a massive manufacturing revolution, powered by a lot of these companies which are coming in to set up a base in India. Third, we know that in strategic sectors like defense and some of the other areas, government has been pushing for manufacturing locally some of these products, primarily because it is of strategic importance that we don't depend entirely on the external world. Towards that, government has been clearly moving and pushing and nudging industry for a locally competent and growing defense industry. Defense, space, some of those industries, we are seeing massive government interest in setting up local manufacturing facilities. So all these reasons are setting up a perfect storm of what we should see in terms of manufacturing activities in the near term. Now let's look at some data points of how this is going to augur well for us in the future. In the next 10 years, India has the potential to become a manufacturing hub. The manufacturing share in the nominal gross value added of Indian economy, which is 14.2% in the financial year 2024, has the potential to grow to 21%. That is about 1/3, 33% higher in the next 10 years' time. That's a massive big jump. Manufacturing gross value add is projected to grow 3.6x to $1.6 trillion by 2034, says a report from Invesco Mutual Fund. Now, what makes India a preferred destination for manufacturing? I want to highlight 3 points. The opportunity is big. Strong domestic demand and one of the fastest growing consumer market makes the opportunity huge for any industry not to ignore India. And there is of course a massive economies of scale and there is a huge export potential. Many of these we are already starting to see them play out in sectors like automobile, ancillaries and so on and so forth. The next factor is a competitive advantage. The competitive advantage is in terms of a well-positioned factor of production. That is, labor and energy is very conducive and reasonably affordable in that sense. Land available in plenty, there's a lot of capital afloat, and there is a spirit of entrepreneurship. The combination of all these 4 factors make it a very competitive advantage at this point in time for any person to enter into manufacturing in India. And last but not the least is the nudge from the government. Government is very keen to have a very strong manufacturing base and it's doing all it can to open the floodgates in terms of initiatives and reforms. Measures to enhance project viability are at a bloom. Measures to boost productivity through productivity-linked incentives, PLIs, are also in place. And measures to increase total addressable market is also something that the government is very keenly working on. So all these 3 factors make India as the preferred destination for manufacturing. What are the companies that these manufacturing funds would be investing into? I'd classify it into 2 parts. One is in terms of existing industries, it could be auto and auto ancillary, especially the internal combustion engine varieties. Pharma is a good place, consumer durables. All these are examples of industries that you could see massive investments. But we're also looking at manufacturing to take shape in the newer industries. These could be in the electrical vehicle space. You should see a largest demand coming there. Semiconductor and fab could be the next big thing that India is looking at making. So you should see a lot of manufacturing happening there. This would be a great import substitute for the growing India that is there. Plus, some of the newer technologies and solar and stuff like that India badly needs will get now locally manufactured. So these are all the new technology areas that are emerging in the manufacturing space. Now, how should you approach these manufacturing funds and should you kind of run in and rush in terms of making? Our view is that it's a great opportunity, but it's an opportunity that's going to play out over a reasonably long period of time. So our best bet would be for you to look at participating it over a period of time rather than at one go. And if you are going to participate at one go, be prepared to sit in for the long haul. Say 7 years or 10 years would be ideal for this segment to play out and give you the kind of returns that you need to see. SIP would be, like I mentioned, a great way to participate and gain from this. This is a theme fund, and ideally one should not invest more than 10-15% of one's overall investment in any theme, and that would itself be aggressive. But our belief is that this is an area that's worth looking at in terms of what we are hearing about. It's of course a risk, but it's a risk that's worth taking as long as you're going to be in it in the medium to long term. So manufacturing is not a fad. It is not yet a fab. It's on its way, but.